Good afternoon. My name is Spencer Levy. I'm an Executive Managing Director at CBRE. I'm very pleased to be joined today by Craig Macnab, the CEO of National Retail Properties, one of the most prominent REITs in the retail arena, focusing on net lease properties. Craig, thank you very much for joining us here today. What Craig and I are going to talk about is a little bit about what's going on, big picture in the retail arena, focusing on what National Retail Properties is looking to buy and other investments that they are doing. And certainly we are all here today at RECon 2012 in Vegas. You can hear in the background a hectic scene of a lot of folks trying to make deals and certainly, hopefully learn a little bit more about what's going on. So Craig, thank you for joining us.
Spencer, thanks very much for having me.
So Craig, National Retail Properties, give us a little bit of an overview of what's going on there. What are you guys looking to buy?
Well, National Retail Properties has had a great year so far this year, and also last year. We bought about $1 billion of net lease retail properties, and it's fun and exciting being here at Command Central of Retail. CBRE Booth booming. Everybody in the RECon seems to be here. No one's at our booth.
Well, we'll try to bring some people over, Craig. But I do note for the record, my guys were at Craig's booth just prior to this showing a deal, so that's exactly what we're trying to do. But Craig, you know, you've been focusing on net lease properties now for many, many years, and certainly coming out of the Great Recession, there's been changes to our business. One of the changes is we've certainly seen the number of buyers going into that space seems to have increased. Certainly harder to underwrite because credit is a much more difficult thing to evaluate because in part the rating agencies had their challenges as well. So if you could just go back from where we are today to prior to the Great Recession, how has our business changed over the last 5 years, certainly focusing on net lease properties?
Yeah, so I think there are a number of different factors. One that's not obvious to everybody, certainly outside our industry, is that there hasn't been a lot of new construction of power centers, community centers, grocery anchored centers, creating out parcels for net lease retail properties. So there's probably less supply today. Having said that, you know, on the underwriting standpoint, the credit is really, really important to the extent you're going to go and get financing on the property. And we understand that many of the people who buy properties from you guys need to go and do that. In our case, our underwriting focus has been and will continue to be on the real estate merits of the property. Credit changes over the duration of the lease, and we do pay attention, of course, to credit, but we're very focused on the real estate attributes, just the traditional metrics: rent per square foot, visibility, access, ingress, egress, competition, who an alternative user would be, etc. So, you know, I think it's just the same old thing. We've got to stick to the basics and keep it simple.
Well, that's very interesting coming from a gentleman who's focused on the net lease properties to really looking more at the real estate side than perhaps the credit side, and certainly other people in our business to have a slightly different point of view. But that certainly brings up a question regarding how you can be most effective as a buyer, and many of the net lease properties have shorter term leases. Some of them are 5 to 10 years, and then you have a whole other category of more than 10 years, more than 15 years. One of the things that we have been seeing challenges with recently, which may be an opportunity for you, are those shorter term leases, those between less than 10 years remaining in term. Does that create an opportunity for National Retail Properties?
Absolutely, and you're wise to identify it. We are clearly playing in that space of shorter lease term. For example, we've just, in the past 60 days, closed on 3 Walgreens. Each one had 3 separate sellers, 8 or so years of lease term remaining, and somebody had some debt coming due and created an opportunity for us.
Well, we certainly completely appreciate the fact that you're looking at it from a real estate perspective, perhaps more so than from a credit perspective. At the same time, there are some of the big box users that are having some troubles and that have been publicly announced, from Best Buy to Sears, and certainly prior to that, Borders and Circuit City. To what extent, or how do you go about mitigating some of the risks associated with those types of downsizings?
Yeah, so just thinking of your earlier question about the credit, as you pointed out, company like Circuit City 5, 6, 7 years ago was in Jim Collins' good to great, no debt, and today there's nobody in these halls working for Circuit City. Credit's elusive, it's just fleeting, it comes and it goes. So what we've got to do is just stick to the basic metrics, but in our case, we've got 1,500 little children that on average cost us $2.6 million a piece. So we like small box retail. We do periodically step out of the box and buy bigger properties. We recently purchased $140 million of BJ's. For us, it was a good opportunity. We think they're at the right connection of value retail. They're clearly executing well, but we're not ready to have to release those big boxes, that's for sure. But just to say one more thing, to give some of your colleagues a perspective. We recently purchased in the last 6 months a portfolio of 12 Best Buys. Obviously, it would be hard to get financing for those Best Buys today, but they're under a master lease. Our average rent in that portfolio is $7.80 a foot, and several of those properties are extremely well located. To be honest, we look forward to having discussions with Best Buy as there's a higher and better use for most of that real estate.
Well, that's very interesting, Craig, and that certainly gives you a competitive advantage going into areas within retail real estate where others are a little skittish. I'm sure you got good value buying those assets as well. Well, one of the things I've always admired about your company is your creativity. And I know many years ago, we talked about your expansion into certain areas of retail that other people weren't going. I think we talked about veterinary clinics or other areas that are not in the main of most net lease real estate investing. The other thing we've talked about is the other types of capital you bring to the table, build-to-suit capital, for instance. Talk about a couple of the ways that National Retail Properties is looking to be creative in their ability to be not just a good buyer, but also a good partner for your clients going forward, and then also comment if there are any segments of the business you think, wow, this might be a good place for us to invest because you just don't see as much, you see good dynamics, but not as many people chasing it.
Spencer, a lot of good questions in there, but directionally, we are always trying to broaden our category of retail net lease. So if it's a big box, we're trying to expand the sandbox we're playing in. So right now, we see a fairly good opportunity in some of the retail categories of healthcare. That's not hospitals, that's not skilled nursing, it's not Alzheimer's clinics, but things like dialysis centers we find very attractive. It doesn't matter what happens to reimbursement, people that need dialysis are going to get care. There's some very big national operators. We just dipped our toe in the water there. So that would be an expansion of the category. Is it retail? Is it healthcare? If it's got a consumer going to that property 3 times a week, we can call that retail. I understand somebody else might say it's healthcare.
Sure.
But other areas of things that we're trying to do is where there are gaps in the market, we are trying to bring capital where there is retail real estate behind. 3-4 years ago, I mistakenly was convinced that there was going to be an opportunity to buy real estate from lenders. We hired somebody to focus in on that area, and here we are today. We've been paying that person's salary for 3 years, and it hasn't been a good investment. Not for his efforts have been good, just like a lot of people, that market didn't pan out. I think right now there's more and more bank financing available for developers, but in secondary markets, developers are still struggling to get high loan-to-value credit, and we are participating in that market a little bit. So with seasoned operators, we're continuing to provide them capital, and we're very flexible about how we do that as a partner, as takeout finance, just something that makes sense for both of us, because what's really important to us is 85% of our transactions are done with people we've done business in the last 6 months. So it's got to be a fair deal for everybody if we have these relationship tenants. So.
And what percentage of that was repeat? Would you say over 80%?
85%. So we bought $1 billion of real estate in the last 15 months. 85% of that has come from a tenant or a partner we did business with in the last 6 months.
Wow, that's amazing, and I think that's testament to the creativity you bring to the table, not just as being a good buyer, but being a good partner, being able to provide additional capital, which makes you more competitive, particularly in some of these secondary markets, which really are still capital constrained today.
Yeah, that's right. And I mean, capital today is increasingly plentiful, but I think that what we are trying to do is bring a consistent approach, a flexible approach, and one that is balanced. I don't want to tell you we give the store away.
Yes.
But if we're bring too much of an institutional bias, we're going to be a lousy person to do business with because there are too many other people for your colleagues to take their business to.
Sure. So final question, let's take out our crystal ball. Let's look ahead through the end of 2012, going into 2013. What do you see as some of the major opportunities or challenges that we may face within the retail sector, net lease in particular, whether they're related to tenant issues or bigger picture, the macroeconomy, the interest rates, U.S. elections? What are some of the things that you look out for and say this is a risk or this is an opportunity for the next year or so?
Yeah, so I'm skinny as a rail, which means I spend too much time worrying. And worrying about things you can't control is not a recipe for success. But I think the situation in Europe could have a meaningful impact on our economy, and I think that bears a lot of watching. It is happening like a slow train wreck, but then there's nothing we can do about it. But it's going to impact consumer confidence. I think as a nation, we've got to find a way to create jobs, and that's not just talking about it. If we don't educate our children, we're not going to have consumers for our tenants going forward because those jobs are too easy to replace overseas. So I think there's some big headwinds. I think what it's going to do, though, is it's going to keep interest rates low, and it's going to, if anything, reinforce the desire for alternative income from the average investor, which means that real estate is right in the sweet spot. I think that cap rates are going to remain low. At attractive loan to value, we're going to have more banks in our space, so there's going to be lots of demand for real estate, and frankly, retail real estate, and I don't see a great deal of supply. So real estate's a good place to be in. I think you and your team at CBRE have got the wind in your sails, and I think it's going to be a couple of good years for you guys.
Good. Well, we're certainly looking forward to forward to doing more business with you, Craig, and your team. And on behalf of CBRE, I want to thank Craig Macnab, the CEO of National Retail Properties, for joining us today at RECon 2012. And hope everybody enjoys their conference and has a successful visit. Thank you very much.